Hi, Harry Dent here for the rant, delayed to Monday because I was traveling on Friday. So we continue to be in a very important place for the markets because they are trying to decide if they can keep moving sideways to up, which is what the Federal Reserve prefers. They want an economy that never has a recession, living in la-la land as if that's the best. And we know, and we want a recession, okay? Because we can see it coming. And in a downturn, a bigger downturn in the markets, even in a time of slowing long-term demographic trends, will give us a much more dynamic market where we can make much better investment profits predictably in the future. So I'm rooting for the Fed to fail here, to not keep control of the economy, which basically gives us two scenarios here. If the Fed can keep kind of control and we still don't make new highs because we tried to make new highs already and it's already questionable that the markets would bounce that strong after 550 basis points, the largest stimulus package since the late 70s, okay? I mean, the markets don't do that. They don't go up when the Fed's tightening the most aggressively in decades. But that's what they did because that's what a market on crack does. So again, that's the key issue here. Do the markets finally start to win here and eventually win? And that's what I'm rooting for, okay? So really, with the point, are we going to finally have the crash of a lifetime that really should have come after the first one, 2008 to 2009. That one should have gone deeper, longer into 2010. That would have been the natural cycle, and with the decennial cycle into 2010. And then a bounce, and then we would have had a second crash when the technology, the 45-year technology innovation cycle peaked and turned down from 2020 forward. So the demographic, generational spending cycle peaked 2007, first crash, bounce sideways, and then second crash from 2020 into late 2022. That would have been the natural cycle. Well, again, since the Fed took over in 2009 with 14 years of nonstop stimulus until early last year, and now they're forced to tighten because they loosened too much over a temporary COVID crisis, which to me is not intelligent. If you're going to overstimulate, at least do it intelligently. So that's where they're at now. We've gotten this bounce, okay? They prevented another depressionary or major downturn, but they were forced to tighten because they overreacted to COVID. To me, the fatal mistake. So do we get this crash of a lifetime on a delay? About 2 years later? Remember, the natural crash would have been late 2019, early 2020, into late 2022 on all our cycles, 10-year, 20-year, 40-year, and the big one, the 90-year cycle, okay? With the greatest, that's the greatest bubble cycle, going back to 29 to 42, okay? And the crash from 1836 to 1842, major ones, okay? Does the economy take back over, or does the Fed keep us in a control nature, and do we just move sideways in this kind of 10,000 bottom to 16,000 NASDAQ top, and probably on the lower side, because we don't let the economy get rid of bad debts and zombie companies? And after a bubble, like the one from 95 to 2000, and this one from 2009 to 21, you're always going to get more misinvestments, more bad debts, more zombie companies. So the economy cannot move ahead as productively, even in this lesser and less long millennial boom, which should have been, basically from 2023 into 2037, now being delayed. It would be 2025 into 2037. But if that boom's going to be strong to provide good investment profits for us, we need the markets to go down here. So what am I looking for? The first sign here that this crash is continuing. It's not a conclusive sign, but the first sign that we're continuing likely to head down would be a break near term of 25,124 on the NASDAQ. We've had two bottoms around there and in the recent rebound rally, so that'd be a sign. Nope. The downside is building. In the October newsletter about to come out, I'll be looking at further support levels that confirm that we're moving into the third wave down of a much larger crash rather than an extended sideways market that really, again, with the demographics, which I know better than anybody, and with the overvaluation, there is no way we're moving to sustainable new highs in the coming years. So we either go sideways in a mediocre market, or we crash and get the markets back to where it would be, wash out all the inefficiencies, and then have a real strong millennial boom. It will never compare to the baby boom, 83 to 2007, but it could be much stronger and we can make much bigger profits in the future. So again, that's the two scenarios. We want the bigger crash. We're ready for it, okay? We've had people out. We've given very strong sell signals in the last year, okay? So we're ready for it. The more the markets go down and get down to fair value, the more we can take advantage of the next great boom. And it'll only be the next great boom if we wash out the excesses from the baby boom, which now have extended from 2007 to the peak in 2021. So again, this is what we're looking for. This is an important time. First of all, stay out of the markets here. This is not a buying opportunity. If we do see one, we'll let you know. But if we do continue breaking down, we expect this to get nasty into the end of this year and even more so into early next year. And that will just be the third wave down in this larger crash. And it will be followed by a bounce for a few months or so, and then a fifth wave down that is not likely to bottom until well into the second half or even the end of 2024. So again, be cautious here, be out. The treasury bonds will do pretty well. Now here's another thing we get. I'm always like, well, why aren't the treasury bonds moving more? They move modestly as the economy starts to weaken and then explode as the ultimate safe haven, okay, when the crash happens. So those bonds will reward you modestly, and they're much better than being in cash, but being short stocks, particularly the NASDAQ, PSQ single short, SQQQ, people want to use less money and have more cash reserves. That is the best way to play this level. And in the next wave down, the bonds will trump over stocks and do the best at the worst of this. So, but it's still long treasury bonds, 10 and 30 year, TLT, ZEROs, TMF, triple, and short stocks. But I prefer being short the NASDAQ through PSQ single and SQQ triple, which again, you can use still have a lot more cash on the side for opportunities that prop up in a downturn or how these markets go, and still be short the market. So I will keep you updated, and my fingers are crossed. I want to see this market start to go down and get to where the economy wants it and not central banks and governments.